Welcome to This Explainer. Today, we're putting on our detective hats and diving straight into the raw numbers behind GATX. If you're the kind of person who loves looking past the flashy headlines to see how a business actually operates, well, you are exactly in the right place. We're going to piece together the real financial story driving this stock.
Because honestly, how does a stock deliver a 432% return over 10 years? That is the staggering question we're tackling today as we look under the hood. A return like that absolutely turns heads, but you and I know that kind of growth doesn't just happen by accident. It's built on very specific financial mechanics. And yeah, sometimes a few hidden risks.
To make sense of all this data, we're going to break the story down into 5 quick parts. GATX at a glance, historic returns and growth, the profitability engine, valuing the stock, and finally, dividends and warning signs.
All right, Section 1, GATX at a glance. Let's look at their baseline market vitals. So let's start with a quick financial physical. You've got to know the baseline before you diagnose the whole organism, right? And we are dealing with a heavyweight here. GATX is sitting on a massive market cap of nearly $7 billion. What's really interesting is the current price. It's hovering right around $196, which is incredibly close to its 52-week high of about $205. It's bounded way back from its low of $143. So right off the bat, the market is clearly viewing this company with a ton of optimism. The baseline vitals are undeniably strong.
Moving on to Section 2, historic returns and growth. Let's talk about momentum over time.
A stock sitting near its high is one thing, but the journey it took to get there? Wow. Just let this number sink in for a second. 432.23%. If you had just held on to GATX for the last 10 years, you'd be sitting on a massive 432% total return. That's an annualized return of over 18% for a straight decade. It is literally the kind of long-term compounding that investors dream about.
But how steady was that climb? Well, if we look at just the last 3 years, you really get a feel for the momentum and the volatility. We started with a pretty modest 4.1% return in 2022. Okay, not bad. But then things started heating up. 2023 brought a solid 15.2% gain. And then, boom! 2024 delivered a massive 31% leap. It perfectly captures how momentum can just accelerate, giving shareholders a fantastic run over the last 36 months.
And you know what? This isn't just stock market hype. Sometimes prices totally detach from reality, but not here. The price action is totally backed by fundamental business growth. Over the last 3 years, their top-line revenue grew at a compound annual growth rate of almost 11%. But the real magic? It's further down the ledger. They generated a robust 28% annualized growth in net income and nearly 26% growth in earnings per share. Think about that contrast. Revenue growing at 11%, but net income exploding by 28%. When a company's bottom line grows that fast, it's absolutely no wonder the stock price has rocketed upward.
Which brings us to Section 3, the profitability engine. Let's look beneath the revenue.
Okay, so growth is great, but as financial detectives, our next question has to be, how efficiently is GATX actually turning that revenue into pure profit? And we find a fascinating contrast here. On one hand, they boast a sky-high gross margin of nearly 76%. That means the direct cost of what they do is super low compared to what they charge. But follow the money down to the bottom line, their net profit margin drops all the way down to 18.3%. This massive gap is a huge clue. It tells us it takes a lot of overhead, depreciation, and general operating costs to keep this specific engine running.
But here's the thing, despite those heavy operating costs eating into the gross margins, they're still delivering a solid return on equity of nearly 12%. For an established company like this, an ROE of almost 12% proves their underlying profitability engine is fundamentally sound. They are really effective at using shareholder equity to churn out consistent profit. All right, Section 4, valuing the stock. Is the price actually right? So, the company is growing and it's profitable. Awesome. But the absolutely crucial point of our investigation is figuring out if the stock is trading at a premium or a discount right now. Because a great company isn't always a great buy, right? To figure this out, we need to look at the PEG ratio. This is a fantastic tool because it balances a stock's current price, its earnings per share, and its expected growth rate. It levels the playing field to tell us exactly what we're paying for future growth. Normally, a PEG ratio around 1 is considered fair value. Currently, GATX is sitting at 1.39, which is actually about 29% higher than its 3-year average of 1.08.
We're seeing that exact same slightly elevated story when we compare the current price-to-earnings ratio against its recent history. GATX is definitely running a bit hot right now. It's trading at a 21.4 PE ratio, which is roughly 9.5% higher than its 3-year norm of 19.5. Basically, investors are clearly willing to pay a premium for these shares right now compared to what they were paying just a couple of years ago.
In this premium valuation narrative, it is totally confirmed when we look at the enterprise value ratios. Whether you're looking at EV to EBIT, EV to EBITDA, or EV to sales, every single one of these current metrics is sitting solidly higher than its 3-year average. For instance, they're trading at over 10 times sales right now compared to a historical average of 8.8. The market is pricing in a whole lot of optimism. So if you're buying in today, you are absolutely paying full price, maybe even a slight premium for admission.
Let's head into our final section, Section 5, Dividends and Warning Signs. Time for the final clues.
Because every good detective story needs a little nuance, right? Let's dig into the perks of holding this stock and some potential red flags hiding deep in the ledger. This is where we separate the casual observers from the true financial sleuths. On the bright side, GATX rewards its shareholders with a remarkably safe dividend. Now, a 1.35% yield might not sound massive at first glance, but look at their payout ratio. They're using barely 27% of their earnings to maintain this yield. That is incredibly safe. It leaves them plenty of cash to reinvest or cushion against a rough year. Plus, if you hold the stock, that yield grows over time, pushing your 10-year forward yield on cost up to an estimated 2.34%.
Even better, they have consistently increased this dividend payout for 15 consecutive years. No way, right? Just think about everything that has happened in the global economy over the last 15 years. Through all those wild cycles, GATX just kept hiking that dividend. It's exactly the kind of rock-solid reliability that long-term investors are constantly searching for.
But let's grab our magnifying glasses again, because to understand the impending warning signs, we've got to talk about free cash flow. Free cash flow is the actual, tangible cash left in the company's bank account after paying for operations and maintaining their assets. It is literally the lifeblood of a business. You absolutely need free cash flow to pay off debt, buy back stock, or, pay those dividends we were just praising.
And guys, this is where the plot dramatically thickens. GATX currently has a glaringly negative free cash flow. We're talking minus $683.6 million over the trailing 12 months. Just let that sink in. Despite that massive net income growth and those beautiful gross margins we talked about, when it comes down to actual cash generation after asset maintenance, they are deeply, deeply in the red right now. And it gets heavier. Compounding that massive cash flow deficit is a debt-to-equity ratio of 4.56. So for every single dollar of equity, they're carrying over $4.50 of debt. It's kind of like a homeowner carrying a massive, incredibly expensive mortgage that demands constant servicing. In a world where capital actually has a real cost, holding this much debt while generating deeply negative free cash flow, that is a massive clue that risk is actively building up on their balance sheet.
So, as we wrap up this explainer, the financial story of GATX leaves us with a totally fascinating juxtaposition. It all comes down to one final, provocative question. Does a history of massive 432% returns and 15 straight years of dividend reliability actually outweigh the glaring red flags of high debt and a $683 million cash flow deficit? It is the ultimate test for a financial detective. You've got all the clues right in front of you. Now it's up to you to figure out how this next chapter is going to unfold. Thanks so much for joining me on this deep dive. Keep asking those hard questions, and always, always keep looking at the numbers.